From CRI Simple Numbers, this is Profitability Playbook, the Simple Numbers Podcast, a podcast for those championing market growth and anchoring the nation's economy, small businesses, and entrepreneurs.
Hey there. Welcome to another episode of the Simple Numbers Profitability Playbook Podcast. I'm Mike Maxson. That's Brandon Gray. And here we are again. I swear, man, we do these like every day. Or is it just this week we're recording?
You just enjoy it so much that it feels like every day. You know, can't wait for the next one. And I'm sure everybody listening feels the same way. You know, they're like, hey, we absolutely cannot wait until the next episode of the podcast.
I know. Yeah. Funny thing is, for those listening, we've had a few people been, reaching out to us. The engagement's been good. I've gotten a couple people reaching out of some topics, some people working out, wanting to work with us, some people reaching out about the summit, and then just current clients reaching out. Like, talked to one today. Hey, Mike, so you were talking on the podcast the other day. I'm like, oh God, what did I say?
Yeah, what did I say? What bad advice did I give? Right? Yeah, it's fun. We appreciate it.
As long as the powers that be don't call up and be like, hey, about what you said on that podcast, because I don't think I say anything too bad, but you never know.
We're good.
For those of you that don't know, when I first started with Brandon and then at Simple Numbers a long time ago, 15 years ago, roughly, whatever that was, I was like fresh out of the Army. And so I don't know if y'all ever did any time, but it was a very difficult transition for me and my mouth and how I had to, conduct myself. Because, just let's be real, in the military, you just say what you ever need to say. And so I've polished up a lot more over the years. So I'm glad, because we wouldn't have been able to do this podcast in 2012.
Well, we would.
Not going to happen.
It would just, it would have a different rating on it.
Right. Yeah, you're right. Yeah, it would be. I don't know what section of that is on the podcast, but yeah, definitely rated R for Mike's mouth. So anyways, so we're back today. I'm going to talk about some growth versus scaling. And so what, Brandon and I, on the last episode that you all have, I'm sure, listened to, we talked about the shifting of the black hole, and some of the things we talked about in that episode and even prior episodes we've done is really growth versus scaling. And about a year ago, April 24th, so season 2, or April 24 of 2025. So that was season 2, episode 14. We had Dr. Gad Allen on there, a Wharton professor, to talk about growth versus scaling and what that is, because you'll hear, some people think it might be the same thing, and it's not. Growth is when a company makes that push for growth, you tend to see their revenue and expenses move up in line with each other. And so they're making the investments, the revenue's going up, not necessarily maybe the profit, but they're moving sort of up together. When you achieve scale, you begin to see that overhead section of the business sometimes, and obviously the labor components begin to achieve a level of normalcy, and then the revenue just continues to go up. And I'll give you a classic example of this is, hey, you've gotten out of the black hole. So we said last call was in somewhere from 3 to 10 million. You're going to be in it, and you started coming out of it. And you're going to probably not be adding overhead. For example, how many bookkeepers are you going to hire? You're going to hire a new bookkeeper every year. Your accounting staff does not grow initially, like maybe your direct labor does. So you're gonna sort of settle into, hey, we have 2 people on the accounting staff. We don't need to add anymore for a few years till we achieve maybe some more revenue. So that's a low hanging fruit example of overhead really beginning to smooth out, and the revenue now is just growing because, hey, we've got marketing dialed in, we've got what we use internally in terms of software. All that stuff's not changing. And so that is the difference between growth and scale. So remember, growth, revenue, and cost moving up in line together. Scaling is where you see that revenue move up, but a lot of those costs beginning to just steady out without, and then you would just have your major investments that you do occasionally for maybe another growth push. But we're going to talk about that today, and we're going to go through some things. So, Brandon, what are we going to go through in more detail today on this growth versus scale?
Yeah. So, like you said, about a year ago, we went through kind of the concept, and it was fitting today to talk about it because last episode we talked about black hole, which you're probably not scaling when you're in the black hole. You're hopefully growing your way through it, but not necessarily scaling in many cases. And so now, as you kind of start to see, coming out of it, then what does scale look like? So we're going to march down your P&L statement, and we're going to go through the different categories, and we're going to talk about how can you identify if you're growing or if you're scaling in those categories. And we'll start with our favorite, gross margin. So what does growth of gross margin versus scaling of margin look like? Well, for this one, you're going to look at your gross margin as a percentage of revenue. If it's staying level, the percentage is level, but the dollars are going up, you're growing. Nothing wrong with that. It's great. If you see the percentage and the dollars going up, you're starting to scale gross margin. So what would that require? Well, I have to either change the relationship I have through revenue and cost of goods through pricing. So if I increase prices, COGS stay the same. Now I'm achieving some scale. Or I've got to find a more efficient way of acquiring and using the cost of good resources. So that might be a contract, right? So am I going to just hit the easy button and use all the subs that I normally use? Or am I going to shop the subs? Am I going to negotiate with the subs? Am I now at a level to where the purchasing from my vendor of maybe raw materials or items to resell has reached a level to where I got a little purchasing power? And now I can buy a little more in bulk, perhaps. I can work with them on their pricing, get it down just slightly, some of those kind of moves. And when you can make some of those, you start to see, all right, I was running 65% gross margin. Now I'm 67% gross margin. Just the little tweaks there. And that's 2 points of profit. Keep that. That's profit. 2 points of profit that drop right to the bottom line. So to determine scale versus growth of margin compared to revenue percentage, am I seeing that flat or is it going up? So that's the first one. And that's a big lever. It is one of the biggest levers. It's also one of the most difficult to move by nature. But look at that and see which of those am I going to make. Mike, anything to add on that one?
Yeah, just I feel too, as companies do get bigger and you get more seasoned, your sales and marketing get dialed in, you also begin to, and then not all cases is this, but you begin to generate different deals with companies. For example, when you are growing, there are times where if you take maybe a big deal, but at a lower gross margin, let's say you take $1 million deal, but it's at a 50% gross margin instead of 70, but you're getting a lot of gross margin dollars. You sometimes tend to need overhead support just simply because you're not big enough to handle it. But as you get more in the scaling mode and you take on a big deal, a lot of times it might be at a lower gross margin, but it doesn't take a whole lot of overhead to support it anymore because you have the systems, the processes, everything are in place. So remember that too with gross margin. You're going to have you got to think about some of those deals differently when it comes to the margin in growth mode versus scale mode. I hope I said that right, Brian.
Yeah, great point. So to clarify, when I was saying that, based on existing services and products. So if you're adding a new project or something like that, yeah, I'm not saying turn it down because I can't scale gross margin percentage. It's about the dollars at the end of the day. So the next one is labor. So we got the 2 buckets of labor. We got direct and management. So let's kind of talk about each of those. Historically speaking, and I'm emphasizing historically because the world we live in is changing quickly with, hey, Mike, a robot just finished mowing my yard again. So, right. So everything's changing here in terms of how we looked at labor efficiency with AI, robotics, everything that's hitting. So historically speaking, if you're seeing your direct LER stay flat, now it's up from history, it's come up, it's reached the high and it's staying level, I'm growing. Because that likely means as your margin dollars increase, I'm just having to add more direct labor team to accommodate the growth. All right. If I'm able to increase my direct LER beyond where my normal highs have been, now I'm starting to scale that labor. Well, how'd I do that? Some may come just through the natural occurrence of a team member getting up to speed. So think about it. You're going through the black hole, you're growing, you're pushing revenue, you're adding team member, adding team member, adding team member. As those folks mature a little bit in their career, they're naturally going to get more efficient if you train them properly, right? So some can occur through that. Also, as you start to scale, you work on systems and processes. And so maybe now we're able to work more efficiently. We're able to use tools, resources, AI, whatever it may be, robots to supplement our direct labor so that we can reach different levels of labor efficiency. So growing is its level at a high, scaling, it continues to move up. On management LER, management labor, growth versus scale, same kind of thing. If your management LER is staying flat, that means I'm growing contribution margin, but I'm having to add management labor. You're going to see that in the black hole. That is the signature of the black hole. As you come out, we should start to see that move up pretty substantially. And if you're not, there is a problem somewhere. Just like Mike said at the beginning of the podcast. How many more bookkeepers you need? How many more marketing people you need? How many more CEOs you need? You don't need another VP of ops. I mean, you should really, coming out of the black hole, and as you're coming out of it, you should start to see it happen. You should be seeing that management LER go up. And I'll give you a great example. So we talked in the past about what should management LER be at. If you're 5 million or below, it's typically 350 to 450. If you're 5 to 7, maybe 8 million, you usually go 450 to 550. If you're above that level, as you get to 10 and above, it should be 550 to 650 or possibly above. Now, big difference between a 3.5 LER and a 6.5 LER on management labor. I mean, that's huge. And so that's what I mean by being able to scale that expense. I'm finding a way, and don't forget what we talked about last episode about the black hole when it comes to labor ads. I want to strategically hire based upon the need, especially in management labor, for a continuous skill set. All right. So I'm going to give you a story of a client of ours, probably maybe listening. If so, you'll know who you are. This was last year before. Fairly large company, over 10 million in revenue. Felt that they needed a CRO, a chief revenue officer. And so they pulled the trigger, very expensive hire. For the first 6 months, rock star. I mean, looked at products, looked at their offerings, looked at their pricing, their target market, managing the sales team. I mean, they came in and did phenomenal work. The next 6 months, there wasn't a whole lot for them to do. They kind of had put the systems and processes in place. They had the house in order. Everything's just kind of status quo. They're moving, they're growing, life's great. And then they kind of get to the end of the year and they go, man, we're paying this person a ton of money. One of the highest paid people on the payroll. What are they doing now? They let 6 more months go by, evaluating and watching it. And there was still nothing to do. And it wasn't that person's fault. There was nothing to do. They had a temporary need that they brought in a permanent team member for. So they graciously parted ways and, realized next time I have a need in a similar fashion, I'll hire a subject matter expert for 6 months. So keep that in mind as you're kind of working through that. Don't just immediately go and hire. Let's scale as far as we can first. So that's margin, that's labor, Mike. Anything to add to that?
The key word I've always thought of when you're in grow mode is leverage. To get to scale, it's how do you leverage everything along the way, leverage that overhead, that you're not doing as much anymore when you achieve scale. And so where you see a lot of businesses in grow mode and run into roadblocks is when they throw labor at problems. They ignore some of those systems because it's like, hey, we're growing. And that's why you see a lot of those costs move up. And I'm not saying they're not going to go up, but a lot of times when people come to us to work and they're moving through that black hole, they're doing what Brandon said. They're adding sometimes unnecessary labor where they could a fractional resource. They're not monitoring those costs. They're Brandon has talked before on this podcast about using a player coach to sort of move through there. But always that word leverage comes to mind when you're moving through there. And then scale, the leverage becomes built in. It's already there that you've achieved through growth. And so just keep that in mind if you ask a lot of people, they just, hey, I'm going to throw labor at the problem. I'll throw more software at the problem. I'll throw this. And it's like, yeah, that's going to cause problems later. Trying to leverage that overhead through the growth as best as you can. And one of those ways, like Brandon mentioned, was outsourcing
Right.
different positions.
There's time to build and a time to maintain. And, you don't need the same type of team for both. So let's talk some overhead expenses. How do we look at scale versus growth with some of these OpEx? And let's start with one of our favorite, marketing. All right. So if you've listened to the podcast in the past, we're big fans of marketing. Marketing spends rocket fuel. You also know that marketing right now is in a tailspin. It is confusing. It is muddy, murky, difficult. The market's changed, right? So here's the things to measure. When you're growing, you'll see your gross margin, which is going to be gross margin minus marketing spend, also called GMAM. Gross margin or GMAM, they're synonymous. You'll see that line on your graph continue to move up. Nothing wrong with that. It's great. Hey, spending more on marketing, I'm getting more gross margin, we're growing along. When you start to leverage marketing, not only will you see that line going up, but you'll look at things such as gross margin per marketing dollar spent, which is an efficiency measure of your marketing. So one is a momentum of your marketing and gross margin. The other is the efficiency. So, hey, I'm able to spend slightly more marketing dollars to get significantly more gross margin because I've experimented with marketing. I know what works, what doesn't work, when to push, when to pull, when to blitz, how much should I spend in different seasons. You got it dialed in. When you can do that, you will see the efficiency, that gross margin per marketing dollar. Notice I didn't say revenue, gross margin per marketing dollar. It should continue to go up. Just as a point of reference, and Mike, you might be seeing something different. I can't tell you the last time I looked at a client's gross margin per marketing dollar and it was increasing. Mike, have you seen that?
Man, if I have, it's rare.
Yeah. So
rare enough that I wouldn't remember it.
It's a challenge. It's a challenge in the marketplace. Cost of marketing continues to increase. It's more and more difficult to drive gross margin dollars. So by nature of where we are, that's going to be a tough one. But it is one, as you're identifying, am I scaling it or not? That's what you want to look at as far as that part goes. If you get really fancy with it, another thing you can look at while we're talking about marketing LER. We've talked about that in the past. About 2 episodes ago, we should see that increasing too. Okay. So scale.
Brandon, one of the things people always talk about, and so I know how we think, but I also know how people think when I talk to them and they love percentage of revenue dollars on marketing. It's thrown around a lot. I'm with you that you said, you're looking at marketing budget, what it's going to cost. You're looking at dollars, you're looking return. We get that. But some people love to know, hey man, how much percentage of my revenue should I be spending? What you got for them?
Well, it depends. And the reason I say it depends is it really is driven more so by your industry and what you do than it is for me to just throw out a number. So I'll give you an example. Let's say you're an attorney, and probably if you get really into the niche, let's say you're a PI attorney, you're likely spending around 20% of your revenue on marketing. It's a super competitive environment. If you've been any city you've been in, it's covered with billboards, radio ads, bus covers, benches, any square foot that can be marketed has got a PI attorney on it. So you got to spend a ton if you're going to go that route. versus, let's say, a general contractor. Most general contractors, they could put up 20 billboards and no one's going to call them, because it is a referral and word of mouth and recommendation type of environment. And so, when you start to throw out a percentage, it's like, okay, it depends upon what you do. If we put everybody together in the 100 company model, it's somewhere between 3 and 5% in most cases. That's what we see being spent. Now, if you're a PI attorney trying to spend 3%, good luck, right? If you're a contractor spending 3, you're probably doing great. You might be spending too much. So, great question, but you got to get a little more specific as to what we see. And I also, and I think you kind of alluded to this, Mike. I don't care what you spend. It's kind of like labor. I don't care what you spend on labor. All I care about is what return are you getting on it. You can spend, you can say, I'm spending 25% on my revenue or of revenue on my marketing. Well, if gross margin and marketing per marketing dollar continue to go up, great. You probably can't hire quick enough if that's the case. So it's more about the return than the spend. So, all right, so we covered gross margin, direct labor, management labor, marketing. Let's talk about this other bucket of OPEX, which is going to be facilities, tax and benefits, and other OPEX. So on facilities, this is a tricky one. Once again, kind of depending upon what you do can somewhat determine this. Let's talk like something like home services, to where you're going to have in facilities a lot of vehicle costs. You add a technician, you add a vehicle. It's really difficult to scale that bucket. I'm not saying you can't, that you shouldn't strive for it, but if you look at it as a percentage of margin, it typically is going to move up. It's almost like a direct cost in that regard. The areas I can scale within it, though, are the actual physical facilities. But I can only scale those to a point. And we talked a little bit about this in the black hole episode. I want to push that committed facility spend to the absolute last thing that I do. So what you see more so with facilities is scale, and then it levels. Scale and it levels, because I'm having to, either acquire more space, add more vehicles, and what have you there, kind of along the way. So that's one, like I said, it's more like a growth. You're typically going to see that going up. If I see it, what I'm watching for there is it growing faster than what my margin dollars are growing. Okay. That it's more so to the other end than it is the scale end. Then tax and benefits, we compare that to a percentage of total labor. It's another one that's really hard to scale. Why? Because every time you add an employee, you're paying benefits and taxes. Now, for some large organizations, you're starting to see more popularity with health insurance being or having a large component of it that's self-funded. So, I'm talking like folks that are over 100 employees. You're starting to see more of that taking place because the cost of health insurance. They're doing more self-funded plans and some of that. The other things, is going to be more so tied directly to payroll. So you're probably not going to see that scale as much. However, what I am watching for there is to see, does that percentage move up? Did we change our benefit structure and it started to move up? If that's what the market's requiring, is what it is, but in some cases it's not. So we just want to be careful with that one. And then the last one, and we definitely should see this one scale, other OPEX. So we're looking at the other OPEX line as a percentage of gross margin. If that one continues to grow in the same proportion that revenue is growing, we've got leaks in the bucket. There's a few things in there that are tied to revenue or margin production. Insurance is going to be one of those. General liability, workman's comp, some of those kind of things, right? But the other things, we should find some scale in those. Where we see people miss the boat is around dues and subscriptions, professional fees, travel, some of those kind of buckets. Typically, the larger you get, the looser you manage those, until it hits a point to where you kind of have a come to Jesus moment and you go, all right, we're cutting all this out. It's not necessary. Best example, years ago, I had a client that brought a private chef in 2 days a week to cook lunch for everyone. Yeah. So, you kind of, we call it expense creep. But we should start to see as that margin grows that you should not be growing other OPEX at the same rate. You should be able to leverage that. So we should see that percentage of gross margin going down across time. If not, like I said, look into those categories.
Yeah, other OPEX is also a big inflationary bucket too. You always got to keep an eye on it.
Yeah.
It's always got all those expenses in there. People are jacking up on you.
And so it's when you start to see, I'm not scaling that, you look and go, is it because of spend control or is it because pricing? Welcome to the current marketplace. Everything's going up and the market's pushing back to me with price increases. Okay. Well, I got to figure this equation out because the math will not math if that keeps happening. The only number that can be eroded there is profitability in that case. So that's where I got to go back to my core customer, my competitive advantage. And a great question along those lines. Does your competitive advantage resonate with your target audience? And can your marketing team communicate that? And can your business development team sell that? If they can't, we got a problem. And when I throw that out to clients, you know what I get most of the time? I don't know. Does my BD team know our competitive advantage? Are they pushing that? And that should be the number one reason why people say yes to what you do. So you might have a little bit of work to do there, education, training wise. And if your competitive advantage does not resonate, and by the way, you've heard me get on my soapbox on this one before. Service cannot be your competitive advantage. Why? Because that's what everyone says. Well, our price is higher because we give you better service. You better have some specific examples as to why that's the case, because I can guarantee you, the next person that walks through that door pitching that, they're saying the exact same thing. So it doesn't differentiate you. Now, if you can give some specific examples, case studies, and some real evidence as to why you're better than the competitors, okay, it can work. But don't settle for easy with that one. All right, I'm off my soapbox. So if we do all of those things, revenue grows, we gain a couple points of gross margin, we increase direct LER, we increase management LER, we're able to at times increase the percentage, or decrease rather the percentage of facilities. We see our gross margin per marketing dollar go up, management LER goes up, percentage of OPEX as a percentage of gross margin go down. You have achieved scale. It's easy, right? Just a handful of levers there. But hopefully you guys have got a few things there that you can look at and focus on. Like I said, especially, look at the margin percentage, look at the LERs, look at the margin per revenue or per marketing dollar, and the percentage of other OPEX. Those are the things you're watching to see as it moving.
Love it.
All right.
Well, great.
Hey, we got an announcement to make. They hung around to the end.
Uh-oh.
Yeah, so we've got a little bit of news about the summit that we can go ahead and release. So let me make sure I'm going to tell you this right. I'm going to pull up the information real quick here because I don't want to mislead you. So we've been talking about our Simple Numbers Summit, I don't know, about a month or so now. And it's November 9th through 11th in Austin, Texas. Not announcing the speakers just yet. You're going to start seeing those on the Simple Numbers website, or the Simple Numbers Summit website, which is simplenumbersummit.com. I don't want to spoil the big release, but we've got pretty much all the slots filled. We got sponsors have already been lined up, several already committed. So it is moving along, and you need to go ahead and get your seat. So if you want a discount, you've been listening to the podcast. Like Mike said, you have shown us some love. You've been calling us. You've been emailing us. You've been spreading the word. If you go to the simplenumbersummit.com page and register to attend the summit, you get a discount. I believe it's about $300 discount. But you got to use promo code podcast26. Podcast26 is the promo code. Simplenumbersummit.com is the website. November 9th through 11th are the dates. Lock it in. It will be one of the best returns on investment that you've made this year. So go out there and take care of it. Secure your spot.
Awesome. Well, that does it for us today. Remember, go out there and book the summit. Love to see you there. For Brandon, I'm Mike, and we will catch you next time.
Later.
If you want to know more about driving sustainable profitability for your business or are interested in learning more about CRI Simple Numbers, please visit our website at simplenumberscri.com. Thanks for listening to this episode of Profitability Playbook, the Simple Numbers Podcast. You can subscribe to Profitability Playbook on Spotify, Apple Podcasts, or wherever you prefer to listen to podcasts. If you like what you heard today, please leave us a review. This podcast is brought to you by CRI Simple Numbers LLC, a division of CRI Capital Group LLC, and a subsidiary of CRI Advisors LLC. CRI is the trusted brand under which Carr, Riggs & Ingram LLC, the CPA firm, and CRI Advisors LLC, along with its subsidiaries, deliver professional services. Please note, Carr, Riggs & Ingram LLC is a licensed independent CPA firm offering attest services, whereas CRI Advisors LLC and its subsidiaries specialize in providing tax and business consulting services. These entities operate within an alternative practice structure as defined by the AICPA Code of Professional Conduct and comply fully with applicable laws, regulations, and professional standards. Ready to simplify your business finances and drive growth? Explore valuable resources, books, and tools designed for entrepreneurs and small businesses at simplenumberscri.com.